Every empire believes its money will endure. Every government swears its promises are unbreakable. Yet time and again, history proves otherwise. From ancient Rome to revolutionary France, from the Confederate States to modern Lebanon, people have awakened to find their savings turned to dust, their salaries worthless, and their futures stolen by systems they once trusted completely. Collapse isn't an exception, it's the norm. The real question has never been if financial systems fail, but how you protect yourself when they do. The belief that money and institutions last forever is the most dangerous illusion in finance. We glance at our bank accounts and national currencies as if they're solid ground, but they aren't. Money isn't a foundation, it's faith, and faith can vanish in a single night. That's why history is both ruthless and invaluable. Every collapse leaves behind lessons, patterns, and warnings about what truly preserves wealth and what disappears into nothing. Those who survive economic disasters aren't the ones who believed most in the system, they're the ones who questioned it first. The Byzantine Empire is often remembered as Rome's eastern half, the one that managed to survive for nearly 1,000 years after the West collapsed. At the center of its power stood the gold solidus, a coin so trustworthy that traders from Europe to the Middle East to Asia accepted it without hesitation. For centuries, it served as the medieval world's version of a global reserve currency. And you'd think they would have remembered Rome's earlier mistake, the disaster of the silver denarius, when emperors diluted it again and again until it was little more than tin covered in silver. That story should have been warning enough. But history has a way of repeating itself. Centuries later, the Byzantines began tampering with their own gold. They reduced its purity, mixed in cheaper metals, and quietly stretched its value thinner and thinner. At first, no one noticed. But when confidence finally cracked, trade across the Mediterranean began to unravel. The once legendary solidus had become just another political illusion. The empire's credibility collapsed along with its coin, and the stability that had lasted for generations disappeared. Who came out on top? Not those clutching official money or trusting decrees, but the merchants who quietly stored real gold or invested in land beyond the empire's reach. They were the ones who kept their wealth as everyone else's fortune vanished. That's the first great lesson of history. Governments can't resist the urge to weaken their own money, and when they do, true value escapes to whatever they can't print or fake. Not every collapse begins with governments manipulating money. Sometimes it's triggered by forces no one can control. In the mid-1300s, Europe faced the deadliest pandemic in its history, the Black Death. Between 1347 and 1351, nearly half the population was wiped out. Cities went silent, villages disappeared, and trade networks ground to a halt. Yet the economic aftermath wasn't simple destruction. When half the workforce vanishes, labor suddenly becomes valuable. Those who survived could demand higher pay, and resources that once seemed scarce, food, land, and shelter, became abundant compared to the number of people left. Families with liquid wealth, silver, trade goods, or even just the ability to work, found themselves in a position of power. Farmland and property that once cost fortunes were suddenly cheap. Empty homes and neglected fields turned the post-plague world into a buyer's market. And that dynamic should sound familiar. During the COVID pandemic, the same pattern emerged. Supply chains collapsed. Governments unleashed trillions in stimulus, and inequality widened as those with savings and assets gained ground while others fell behind. In the U.S., housing prices skyrocketed. Stocks bounced back almost immediately, and millions of ordinary people struggled just to stay afloat. The pattern is unmistakable. Pandemics always shift wealth. The survivors of the Black Death used scarcity to rise, just as those with liquidity during COVID bought up property, businesses, and stocks others could no longer hold. It's a harsh truth, but history repeats it without fail. Every crisis rewards those with reserves and devastates those without them. If pandemics reveal how quickly an economy can turn upside down, the fall of Florence's great banks shows something equally important. Even the mightiest financial empires can crumble overnight. In the 1340s, Florence stood as the financial heart of Europe, ruled by powerful banking dynasties like the Bardi and the Peruzzi. These families had lent enormous sums to monarchs across the continent, most fatefully to England's King Edward III, who eventually defaulted on his massive debts while fighting wars with France. When Edward stopped paying, the unthinkable happened. The great Florentine banks collapsed. Depositors lost everything. Trade came to a standstill, and the city that once symbolized wealth and confidence plunged into chaos. For ordinary Florentines, it was a brutal revelation. Size offered no safety, and prestige was no shield. The takeaway was clear then, and it still is today. Too big to fail has always been a myth. Financial institutions exist to make profits, not to protect their depositors. And when they fall, they drag ordinary people down with them. History keeps echoing the same warning, from the crash of Florence's banks in the 14th century to Lehman Brothers in 2008 to modern banks in Lebanon freezing their clients' accounts in 2019. Those who survive financial upheaval are the ones who understand that an institution's promises last as long as it remains standing.
The American Civil War is often remembered for its bloody battles, political upheaval, and the end of slavery. But beneath the headlines of war and ideology, another battle was being fought, one over money itself. It was a financial war that few Americans today truly grasp. Both the Union and the Confederacy learned the same hard truth. Total war demands total spending. To fund their armies, both sides turned to the printing press. In the North, the government rolled out greenbacks, paper notes backed not by gold, but by faith in the United States. At first, it seemed like a bold and patriotic solution. But as more and more greenbacks entered circulation, their value began to slide. Prices rose, confidence faded, and the cost of the war crept into every household. Meanwhile, in the South, things spiraled far worse. The Confederate government, desperate to keep its war machine running, printed graybacks in astonishing amounts. By the end of the conflict, inflation was out of control. Prices skyrocketed thousands of percent. Soldiers' wages were useless before they could even spend them. Ordinary families carried sacks of bills that could barely buy bread. By 1865, Confederate money was worthless, not weak, but completely dead. In that collapse, paper meant nothing. Only real, tangible assets, land, food, gold, retained value. While ordinary citizens watched their savings disappear, those holding physical goods or hard property managed to endure. For Southerners, it was a devastating lesson. A lifetime of saving turned to ash almost overnight. Yet for those with something real to trade or hold, it became an opportunity to buy land and assets for pennies. It's a chapter of American history that rarely gets the spotlight, but it should. The Civil War proved that even the richest nation can see its currency crumble. And when it does, safety doesn't come from paper promises. It comes from owning what no one can print out of thin air. France provides one of history's harshest examples of how revolutions can destroy money even faster than war. During the 1970s, as revolutionaries overthrew the monarchy and seized vast amounts of church property, they introduced a new form of paper money called the assignat. It was supposedly backed by the value of that confiscated land, giving the people confidence that this new currency would stabilize France's shattered economy. But that confidence didn't last. The government, desperate for funds, kept printing more and more assignats. Each new batch weakened the last. Prices soared, wages lagged behind, and the once promising currency quickly became worthless. Before long, farmers refused to accept paper money for their crops, demanding silver, goods, or anything tangible in exchange. In Paris, food shortages and riots broke out again, and the revolution began consuming itself. The real winners in that chaos weren't those clutching stacks of patriotic paper. They were the people who owned food, gold, or land, the assets no government could simply create out of thin air. For the average Parisian, the realization came too late. Even the most idealistic promises lose all value once trust collapses. And when that happens, your wealth doesn't just decline, it disappears completely. 2 centuries later, history repeated itself, this time in Asia. In 1997, a speculative assault on Thailand's currency, the baht, set off a financial shockwave that spread across the region. Thailand had borrowed huge sums in US dollars, assuming its fixed exchange rate would never break. But when the peg collapsed, those foreign debts became impossible to repay almost overnight. Panic followed. Investors pulled their money out in droves, and one by one, the currencies of Southeast Asia, Indonesia, Malaysia, South Korea crumbled. Economies contracted, unemployment exploded, and desperate governments turned to the International Monetary Fund for emergency bailouts. The real pain, though, didn't fall on Wall Street or the speculators who triggered the crisis. It landed on ordinary citizens, families whose savings lost value, whose home loans suddenly doubled in cost, whose jobs disappeared without warning. The pattern was unmistakable. Those who had their wealth stored in dollars or foreign assets managed to weather the storm. Those who trusted their local banks and currencies were devastated. Entire nations built on foreign borrowing were forced into years of austerity, while global investors scooped up Asian assets at bargain prices. What looked like a regional meltdown was really a massive global wealth transfer. And the message was the same one echoed throughout history, from Byzantium to Argentina. Debt owed in someone else's currency is a trap. When the crisis hits, it's never the lender who sinks, it's the borrower. History keeps repeating itself. From France's Revolution to America's Civil War to Asia's crises, the pattern never changes. Paper currencies fail, debt enslaves entire nations, and survival doesn't favor the most loyal citizens. It favors those who see the cracks forming before everyone else does. The frightening truth is that financial collapse isn't just a relic of the past. It's still unfolding in our time. Between 2019 and 2021, Lebanon became a modern example of how fast trust can vanish. Almost overnight, banks shut their doors. Accounts were frozen, withdrawals were rationed. The Lebanese pound lost over 90% of its value, wiping out lifetimes of savings. What once bought a car could barely buy a week's worth of groceries. Desperate citizens crowded outside bank branches, pleading to withdraw their own money, but the answer was always the same. It was gone. And it wasn't just the poor who suffered. Professionals, business owners, retirees, anyone who believed their money was safe behind a password or bank card, watched everything disappear. The message was cruel, but undeniable. Your deposits aren't possessions, they're promises. And in a crisis, promises can be revoked. Those who endured the storm were the few who had protected themselves beforehand, with assets abroad, with gold, with property, or simply with cash they could touch. Everyone else learned the hard way that in the end, safety and money is an illusion.
It may feel distant, but it's not. Back in 2008, millions of Americans lost their homes and retirement savings, while the very banks responsible for the collapse were rescued with taxpayer money. Then came 2020. To stop the economy from crashing during the pandemic, governments printed trillions of dollars, money that pushed stock markets and real estate to record highs while regular workers saw their paychecks barely move. By 2023, confidence cracked again. Regional banks across the U.S. began failing almost overnight as depositors rushed to pull their money. It was a brutal reminder that too big to fail is nothing more than a comforting myth, one that vanishes the moment panic sets in. When everything starts to unravel, the question is simple: how do you endure it? History makes one thing clear: there's no universal formula. In Byzantium, survival meant holding gold. After the Black Death, it was having cash ready to claim deserted land. In Florence, it meant realizing that too big to fail was an illusion. In the Confederacy, wealth was preserved in tangible goods. In France, in the chaos of revolution, it was food and property. Across Asia, it meant steering clear of debt in foreign currencies. And in Lebanon, it meant moving your money out before the banks locked their doors. The settings change, but the truth does not. Survival doesn't belong to those who trust systems blindly. It belongs to those who understand what keeps real value when everything else turns to dust. Here's the uncomfortable truth most people miss. Collapse isn't just destruction, it's redistribution. For those caught off guard, it's devastation. But for the prepared, those with savings, real assets, or flexibility, it becomes a rare moment to gain what others are forced to lose. After the Black Death, land that once belonged to nobles fell into the hands of peasants because labor became scarce.
Centuries later, after the 2008 crash, people with cash bought properties for pennies, while millions lost their homes. History repeats this pattern again and again. Survival isn't just defense. It's about being ready to act when panic sets in, to claim value that collapses always release into the hands of those prepared to take it. True wealth isn't just measured by what you possess, it's defined by what you can produce. The people who made it through history's worst collapses weren't only those sitting on piles of gold or land, they were the ones who knew how to create value when everything else stopped working. The baker who could still make bread, the blacksmith who could fix broken tools, the farmer who could feed others, the trader who could move goods when borders closed. These were the ones who didn't just endure the chaos, they advanced through it. Because when money loses meaning, usefulness becomes currency. People will always need food, tools, shelter, and trade, and those who can provide them will never stay poor, no matter how broken the system becomes. Real protection isn't found in faith, not in banks, not in governments, not in systems that promise stability but always end in collapse. It lies in a mix of tangible assets, practical skills, and the understanding that every illusion eventually breaks. Every financial disaster is a handover from those who trusted too much to those who prepared early, from empty paper claims to real, lasting value, from passive bystanders to builders who act when others freeze. History repeats this handover endlessly. The real question isn't if collapse comes, it's whether you'll be the one left with promises or the one standing with something real. History might not replay exactly, but if you fail to learn from it, it will repeat its punishment. If this changed how you see things, hit subscribe, because history holds the answers, and I'll help you find them.